Hello, everybody, and welcome to this week's Forte Financial Mortgage Group podcast. And I got to say, I'm really excited. I have a very special guest, Chris Rains from Rains & Company CPAs. He does a lot of other things, but that's the piece that we're going to focus on mostly today. Chris has actually been my CPA. He opened Rains & Company CPAs back in 2001 and is just a wealth of knowledge. As many of you viewers here know, we have been talking about the tax advantages, benefits of having a mortgage versus renting. And you'll always hear me say, I'm not a CPA, and we're going to get a CPA in here to clarify some of those things. And that's what we're going to do. We're going to talk today. So, Chris, say hello.
Hello, James.
It's seriously, it's awesome to have you. Thank you for coming. I've been trying to get Chris on this podcast. How long now?
A while.
Probably a year. He's obviously very good at what he does. He's got a lot going on, and I'm grateful to have him here to help share with everyone here what are the specific tax advantages of getting a mortgage, and things like mortgage interest, real estate taxes, PMI. That's something else that we're going to go over. Home equity lines of credit, are they tax deductible? Are they not? When are they? When aren't they? So we're gonna start with some of that stuff. So Chris, I think the biggest thing when we talk about this stuff is, there's always a lot of changes with tax laws, every year, and depending on how much money you make, it can change how much the tax advantages are. So somebody who's renting right now, your average Joe, they don't truly really they understand what it means when something's tax deductible, but they don't really quite get, not everybody, some of them obviously, but they don't quite get it. What does that really mean? So I want to dig into that a little bit. So, we can go over some examples, but maybe you can just start by talking about, generally speaking, what's tax deductible, what's not, and maybe start touching on things, and we'll branch off from there.
Okay. So we're in an unusual time period where we're heading into the last year of the last tax change. So 2025, we will see this restrictions on some of the things that we normally considered tax deductible. So what happened a few years ago in 2018 is that they changed the standard deduction, they increased it, and they put limits on what we can deduct. The limits were wrapped around state and local taxes. It's called the SALT limitation, where we were limited to a $10,000 cap. And in this area, you can hit that really quick between your state income tax and your real estate taxes. And then the mortgage interest was capped at $750,000 max. So you're able to deduct up to the interest up to the debt of $750,000. 2025 will be the last year under those regs. And then 2026, we're not really sure what to expect. Some indications are it might stay the same, but we're not 100%. Obviously, we're not 100% sure until it's done. I was kind of always hoping for a little bit of adjustments here and there, but I'm just not hearing that. I think either it's going to sunset at the end of 2025 and we go back to the way it was, or we just have to deal with the current restrictions. I think any planning that anyone does right now has to be wrapped around what is in place right now, with the assumption it stays in place. So what that means is that the standard deduction increased dramatically. And so, for example, the 2025 standard deduction for married filing joint is going to be $30,000. That means you have to exceed $30,000 of itemized deductions in order to take advantage of itemized deductions. So if you have a situation where someone's real estate taxes are above $10,000 and you have interest above $20,000, those real estate taxes in state and local will be capped at 10, and then your mortgage interest will probably get you above that standard deduction amount. When you hit that level, now you're going to add in things like charitable deductions and maybe medical expenses if you exceed that threshold. So the tax law wrapped around the real estate industry it took a bit of a hit, right?
Right.
You're looking at in this area, that SALT limitation was a big deal, and we were kind of hoping that would go away, but I'm not really sure. And on the original tax law, you could deduct up to $1 million. I'm sorry, the debt itself, $1 million of debt, you can deduct the interest on $1 million of debt. So that's a pretty significant change. And I think I guess the lead up into someone thinking about buying, you have to do some number crunching, right? What is that deduction going to mean to you tax savings wise? And I think a lot of it has to be long-term thinking and not just the first year. You do have to think what's going to happen in the next few years as far as savings that you're going to have. And I did run some numbers, and that's where, you can always kind of get yourself caught up in the numbers. You really have to do apples to apples. And with this type of question, it's hard, right? You have to really dig deep into what you're comparing your numbers to. So we had talked about, I just had to give me some examples. So
yeah.
We talked about married filing joint couple with $150,000 adjusted gross income with a $350,000 mortgage versus a couple with $500,000 AGI with a $750,000 mortgage. So the 150, 300, 350 mortgage, their tax savings is going to be nominal. It's maybe going to be $400 for the year based on some assumptions, right?
Okay.
The other couple buying that $750,000 house is going to have an $8,000 savings during the year. With that said, there could be other things like charity that you can add to that mix, which will increase that tax savings. So if I was looking at a scenario, I would want to know what that tax savings is per month so I can kind of work it into my cash flow budget.
Okay, so let me just pause you for a second. That was a lot of great information that I want to dissect some of it. So the one, all right, so when you said in the example of, and again, this is all approximate and there's a lot of variables, but the $750,000 mortgage and $500,000 AGI, and you said, about $8,000 tax savings. Now, when you say $8,000 tax savings, what you're saying is that the tax debt that they're going to owe is about $8,000 less because they own versus if they would have rented. Is that
Correct.
Basically the long and short of it?
Absolutely.
So, okay. So, that's a pretty healthy savings. So, but now to add to that example, and we'll go back to the other one in a minute. Now you mentioned charitable contributions and things like that. Those now, because they've hit that limit, you're suggesting that those will all also be deducted at that point? Correct. Is that what you're saying?
Absolutely. Yes.
So what would be some examples of other things other than, so you say charitable donation. Is there a cap on charitable donations? Or
No.
is there,
No.
Okay. So that will go almost, off the tax savings you're suggesting. So what would like another $5,000 of donations do in a case like that?
It depends on your tax bracket, of course. I mean, $1,000 to $1,500 would be, in the examples, the numbers that we threw out would be a rough number.
That's great.
Yeah.
Okay.
Yeah.
Now, what if that individual? Let's just branch off of this same scenario again. $500,000 income, $750,000 mortgage. What about now a HELOC? If that person now gets a $100,000 HELOC, to do home renovations, now is that going to be tax deductible under any circumstance, being that they're over $750,000 for a mortgage?
$750,000 is the cap,
and that is inclusive of any home equity line of credit. Okay,
Correct.
All right. So then in that case, the HELOC would not benefit that person as far as a tax advantage at that point because they've hit that $750,000.
That is correct, and I think we get caught up in tax discussions.
Yeah.
I mean, HELOCs are an important asset. The home itself is an important asset. And once you're able to establish a HELOC, it's a very important thing to have because of those emergencies that do come up.
Mm-hmm.
And I really do think that once a homeowner does get to the situation where they can establish that HELOC, they should, and whether it's deductible or not. So,
I mean, I totally agree with you. I mean, I just was trying to educate from a tax perspective, but yeah, I mean, a HELOC, we're always advocating for them. So, all right, so that's interesting. So now, if we go backwards, you're saying the $350,000 mortgage and $150,000 of income married jointly, they're not writing anything off. You're saying in that example, assuming there's no other variables.
Well, so again, if you look at it as a tax angle, they're at break even. It's very nominal tax savings. So then you start to rationalize the other aspects of why you would do it.
Okay.
Right? And building equity in the asset, because every month you're paying your mortgage, you're paying roughly about $400 in the first year to the equity. So it's not that you're just paying the bank interest, you're also building equity in that house, which ties into that home equity loan when it comes time to get it. And then you've locked yourself into an asset that's, hopefully appreciating also. So I would say to you, if someone's motivation to buy a house is tax only, then that 350 is sort of like your break even.
Okay, that's kind of where the break even is. That's a good thing to know. Now, how would it be affected in either of these two examples if, say, there's a major home repair that they needed a new roof which cost $10,000 or new windows for $20,000, whatever, how does that play into these examples?
Well,
from a tax benefit.
A tax benefit. So we're talking about current year to year write-offs. So if you had a HELOC and you were to use that to improve the home, that would be deductible. That would be added if you were under that $750,000 threshold. The other bigger sort of lifetime event is when you sell the house. So a lot of people will ask me, we're putting a roof on. Can I write that off? The answer is no, because it's not a current year write-off, but you should keep track of it. When it comes time to sell a house, that becomes part of your basis. And it's important to have that.
So, but let me ask you this though. And this is, this is what I've been talking about before. There's a lot of stuff. So that a lot of people are very confused too about, okay, well, we're in an environment where a lot of people bought houses who, a couple of years ago that they're worth significantly more now. Mm-hmm. What happens if they want to sell that house? And, what's the amount of time they need to be in there for what, a tax event, or if they roll it into another one? Can you maybe talk a little bit about that?
So the current rule is that if you lived in the house for 2 out of the last 5 years, you're able to take a $250,000 exclusion on the gain. Married filing joint, as long as both spouses meet that parameter, 2 out of the last 5 years, it's a $500,000 exclusion. So you basically take your original cost of the house plus any improvements over the years. Closing costs come into play also. And you calculate a gain, subtract $500,000, and normally that will hopefully be enough to mitigate any type of tax on the gain.
Okay, so even if, and that's great to know, it's great for viewers to know. So even if, let's say they met all those requirements, they sell the house, but they're not really sure where they want to go from there, and they say, we're just going to rent for a year because we just, I don't know, for whatever. They think the market's going to change, or they want to wait for rates to come down, whatever it is. They're okay in that case where they don't have to roll it into another house, like in an investment, which we'll talk about investment properties in a little bit. There's no issue there.
Not at all. You don't have to purchase a new residence. It's just you have to live in there 2 of the last 5 years. The one restriction is, there's a few restrictions, of course, but I mean the biggest one is you can't. You have to wait another 2 years. You can't do it within another 2-year period. So if there was multiple sales, you would have to be careful with that.
Okay. All right. Well, that's good to know. 2 years, 2 years. All right. So while we're on that topic of, and I don't mean to be going all over the place, but I like what we're talking about. Um, you know what? We'll go back to that because I want investment properties is a whole separate piece, which there's a lot of questions there. But one thing going back to like your first time buyers, a lot of first time buyers are putting very little money down, and they have PMI. So now I know that PMI used to be tax deductible, but I know in our discussions, you've confirmed it's not anymore. So do you want to just kind of talk about that for a second?
Yeah, unfortunately, that rule ran out. I think it was 2021 was the last year. You were able to deduct PMI, but they basically taken it off the books, and I really haven't seen much mention of putting it back on.
Okay.
It's a little quiet out there with any type of change, to be honest with you.
Okay. So yeah. All right. So it seems like now again, there's variables like you mentioned, but it seems like for someone to take tax write-offs and advantages, the break even give or take is around 150 for $150,000 joint AGI for a married couple and a mortgage of around $350,000. That's pretty much the break even point where you're not going to see it on your taxes in the first year. Obviously, like we said, there's many other benefits, building equity, just you're not obviously paying rent. There's nothing. There's no benefit other than you have a place to live.
Yeah.
So, yeah. All right. So then above that, that's really where you start to see it. So it's going to be interesting, like you said, to see what happens after 2025.
Mm-hmm.
Obviously, with the new, the change in presidency, I'm sure that'll have some role in which way it goes.
Well, it's interesting because I read an article a few days ago, and it was discussing the parameters, the way Congress plans out tax changes and the budget, and apparently the current tax structure, there'd be the way they scale it, there'd be 0 points if they were to keep it the same. And I think when you have I just feel like there's and maybe this is not really a good topic to talk about because it's more like of my opinion.
No, we don't want your opinion.
Yeah, I feel like there's not going to be much change. There's not much reason for them to change it.
Okay.
And any change to the tax law is going to increase tax rates, right? So if you put back the 100%, you take away that SALT limitation, AMT comes back, the alternative minimum tax.
Yep.
If you adjust anything, the tax brackets are going to be increased, meaning everyone's going to be paying more tax. And they were given averages. I'm not really sure what use averages are thrown out there, but to say that everyone's going to pay an additional $2,800 per year, whether that is a realistic number or not, I don't know. But you have to expect anything changes, they have to recoup it somehow, and because they're looking down the road. And one of the things that is interesting and is off topic is that they're trying to target a certain percentage of the GDP. Currently, we're above 6%. They're targeting 3%. So any changes that they want to put into play will increase tax rates. So if they're not focused on reducing expenses, we're going to be really hit with some serious changes in taxes. So that's why I feel like my personal opinion is they're just going to leave it alone,
okay,
and try to cut costs.
So just for the viewers, and we touched on it earlier, but we kind of went pretty quick. Can you just give a quick what is SALT tax? So how would you explain SALT?
The SALT tax stands for state and local tax. Local meaning real estate tax and city tax, but it's on your itemized deductions. You are able to deduct the amount that you pay to the state for your income tax, the amount of real estate taxes you pay. And in states with no real estate taxes, like Florida, you're able to deduct sales tax. So you add all those numbers up, and in the past, before 2018, if that number was $50,000, you got a deduction of $50,000. That also triggered another thing called AMT, So we were in the situation where we're calculating two different types of taxes, and whichever one was higher, that's what you were going to pay.
Okay.
So that's what state and local tax is, and it's
And that's
capped at
this
that
$10,000 cap.
$10,000. Yes,
Correct.
Yep.
I know a lot of people have heard the term, but they don't
Yeah,
necessarily know what it means when they hear the term.
correct. And I think what's happened in the last few years is the states have sort of circumvented it in this on the business side. It's called the pass-through entity tax. So business owners are able to deduct that liability off of their federal taxable income. So it was a nice workaround
Yeah.
that is in place now. So that's another reason why like once you put, it's like, I don't know if it's going to change. So.
Well, it'll be interesting for
Yeah.
sure. Yeah, the SALT definitely threw a lot of people, especially in the area we're in, specifically in this
Yeah.
Fairfield County, Connecticut. Where people have real estate taxes of a lot more than 10,000 a year just in real estate.
Oh yeah.
So that's interesting. One of the things that I really did want to talk to you about is investment properties and how that really works with, a lot of people just assume, oh, well, I'm going to buy an investment property, going to write everything off. And just maybe you can explain a little bit how that works. And not obviously, because not everyone is getting into it. A lot of our viewers want to get into real estate investing. They don't really know much. So we have everything from beginners to, people have a big portfolio. So one of the things most people do is they end up putting the property or properties into an LLC or separate LLCs. And maybe you can talk a little bit about that, the tax advantages of doing it or not. Clearly, there's a liability, which is separate from tax. What are your thoughts on that?
Okay. So there's a lot. That's
okay.
Unpack that.
Let's just start with.
So as far as
start simple. I'm sorry.
Yeah, no, that's all right. I think from what we're just talking about, what changes is that there is no SALT limitation, right? So now, if you invest in real estate, and it's typically whatever you invest in, unless it's a capital improvement, it's going to be deductible. Meaning, if you repairs, maintenance, that's all deductible. Whereas in your house, it's not. But the capital improvements, it'll just be added to the cost basis of the investment property. And you're able to depreciate it, right? So an investment property is going to give you a lot of write-offs, and you're going to have a lot of times you're going to have a situation where the depreciation, mortgage interest is bringing you down to hopefully still a positive cash flow, but sort of like close to a loss. We've seen it a lot where people are generating losses because of the depreciation. So you have positive cash flow, but the depreciation is taken even to the negative with for the tax reporting. There's definitely some considerations there. Because there's rules around when you can take those losses and you can't. So you could have a situation where one year you could take the loss, the next year you can't. You don't lose the loss, it's carried forward as a passive loss. Okay. Or if you have other passive income, like in your example with the multiple LLCs, you can have situations where you can offset income from other LLCs.
So that's a great start there. So just for some simple questions. So for example, I own my house. I decide, I'm going to get into real estate investing. I buy an investment property, okay? And let's say I fall into the 500, 750, right? Example, 500 AGI income, adjusted gross income, and I have a mortgage on my primary residence of $750,000. And now I want to go and buy an investment property. Okay. So I buy an investment property. Yes. Obviously I have all my costs there, my closing costs, our expenses. I have all my mortgage interest for the first year. Let's say I owned it January 1st, okay, just to make it like it's a full year, all right? And then I have my taxes, all my, my insurance, all my expense, renovation. I put $50,000 into it after I bought it. And then now, and with depreciation, I'm at like a nice negative. Let's say it's negative after rental income. It took me 6 months to even rent it out because I had to fix it up first. So there's only 6 months of rental income there. Now I have like a really healthy loss there when you add depreciation into the first year, so let's say it's a $30,000 loss at the end. What does that mean to me tax-wise in that situation?
So in a typical case, and then we're talking about the 500 AGI
Yeah.
couple. So
Yeah.
once your adjusted gross income goes over 150,000, the rules kick in that limit the loss. So in that scenario, that $30,000 loss will be reduced to zero, and you will carry that forward.
It's a carry forward.
Correct.
Okay, so let's go back to the other example. Johnny homeowner that is making 150 a year combined, and now that 30,000 loss for that person who bought that investment property. How does that affect that individual?
That will be deductible.
All right,
meaning that they'll be their AGI will be reduced to 120,000.
Okay, so that's wow. So that's a $30,000 write off of your taxable income.
Correct.
I mean, that's
Yes.
significant. So 30,000, that's a lot. That's a lot of money that
Yes.
they're not paying taxes on.
Yes, and in another scenario, and this is something that just kind of tiptoeing around because there's a lot to it. In the other scenario, if there was there's participation rules that would allow someone to take that loss even at that AGI, but it's not that it's unusual. It's just it's very, very defined.
Okay.
And real estate professionals would have the ability to
Got it.
write that entire thing off. But if we're just talking about someone that's working for a company, investing money, most likely they're not going to be able to take that loss.
So a realtor, for example, if someone is a realtor and they also own investment properties and they do both, that would be considered.
So a realtor themselves would not.
Okay.
Because it's a very not regulated, but it's very defined.
So if somebody only does investment properties, whether it's buy, fix, and flip, rent,
Yeah.
hold, someone that does only that, which I have quite a few clients that fall into that category. So if that's what they do, you're suggesting that they would be able to not carry any of it forward,
No. If that's all they're doing,
Yeah.
all the time,
Yeah.
they're most likely going to be able to take off that loss.
Right. Yeah.
There's elections they have to make to combine things.
Okay.
So it's a very tricky. That's why I don't want to go into.
I know. It's tough to.
Yeah, it'd be the fodder for the comment section. It's just like it's definitely a.
Gotta love the comment section, Chris.
It's a very technical area that you literally have to open up the books and really get into a specific scenario.
Guys, the point here, not to interrupt, but the point here is that we're trying to educate. There's so many things that will affect each of the specific scenarios we're talking about, but we're giving you a broad stroke. So every little thing will affect all those numbers. This is just to help you understand what some of these things mean, how it could affect you, and again, Chris is the best. He's the only CPA I've ever worked with for my own personal needs, business and personal, for the last, I think, 20 years, Chris.
Wow.
I think it's been 20 years, honestly.
My goodness.
Yeah. It's been a long time.
It is.
So it's, again, we're lucky to have you. Now, is there any tax advantage to an investor to put a property into an LLC versus on their Schedule E of their 1040? What would be the advantage there, and is there a certain type of company that would make the most sense?
So that's a great question because I think there's even banks get this confused, which I find odd. So it depends if it's a single member LLC or not, right? So a single member LLC is going to show up on that Schedule E anyway.
Yep.
So tax wise, makes no difference.
Makes sense.
It's when people ask me that question, I always defer them to their attorneys because LLCs are supposed to afford you protection,
right?
And we're talking about protecting that investment asset in any type of situation. So I think another question that comes up with that is how many properties can I put in one LLC? And I feel like that is a preference that their attorney will tell them. So I've had attorneys want one, no more than three, type of thing.
Okay.
So the single member LLC is from our perspective, is just a title. The IRS really doesn't even give you a space to list that name on that Schedule E.
Understood. Makes sense.
When you have multiple members, now we've just introduced a new tax filing, right? So a multi-member LLC will file a partnership return of Form 1065, which is an extra filing and extra fees on top of what you're already paying your CPAs.
Mm-hmm.
So,
and aside from the extra filing, is there any better tax advantage in that case?
No.
Okay. So then,
I think the kind of, if we were to kind of think about what we talked about before, was that the tax advantage could come from that SALT limitation. So that pass-through entity tax would be available to that partnership. So in theory, you would be able to reduce your income by paying the state the tax and then taking a credit on your own personal tax return.
Okay. All right. Well, that's always helpful,
Yeah,
right?
Yeah.
And as far as people who buy and sell investment properties, listen, a lot of them know this stuff, but this is more for people who want to get into it. We want to try to help them make the right decisions. When you buy an investment property and, you make $100,000, that you buy it, you fix it, and then you sell it and you make $100,000, right? Explain how that looks in terms of taxes. That's considered capital gains, or, what a lot of people do is it's called a 1031 exchange. A lot of you may know what that is. A lot of you probably have no idea what it is, but what do you have to say about, the person who wants to get into this and
so
when they sell?
They have a realized transaction which could result in a gain. That gain is going to be split up into a couple components. The long-term gain, and the assumption is that they've held it over a year, and depreciation recapture. So we have this concept of depreciating, reducing our income, which we talked about before, and we're taking a benefit from that, right? So we're reducing our ordinary income from the depreciation. So people are sometimes surprised to find that if that $100,000, we may have to carve out $25,000. As an example, $25,000 treated as ordinary tax rates. So we're adding back 25 at ordinary rates, and depending on what your income is for the year, what bracket you're in, right? And then the rest of it is long term. The concept of real estate investing, whenever I talk to someone that is constantly or just always investing in real estate, we always want them to consider the 1031 exchange, because it almost seems like a waste of money to sell property, pay the tax, and then go buy more property. So the like-kind exchange has been around for a very long time, but it has been scaled back to only real estate. So, which is unique, right? I mean, you used to be able, companies used to buy and sell airplanes and have this exchange applied to it and not pay any gain on the planes or whatever else, horses and things like that. Now it's just real estate. And, if you're going to pay, if your gain is, let's say 100,000 and you're going to pay 25,000 in tax. So net, you're only investing 75,000 into the next property as part of your gain. So
right.
you're losing buying power by doing this. So the like-kind exchange, which, there's a lot of ins and outs, which I'm not familiar with all of the aspects of it. That's why you basically have to hire an exchange company
right.
to do this.
Sure.
And they're very helpful in walking you through all the aspects of it. But the concept is that you're just deferring that gain into either a sale in the future, or in sort of like in a sort of dynasty concept is, in theory, you can do this for the rest of your life and then pass it on to your kids. And once your kids get it, they're going to get a stepped up basis on your date of death. So, I mean, and it all goes to if you're a real estate person or not, because a lot of people just don't have the stomach for it. But the ones that do and stick it out, they're the ones that you just always own real estate, whether whether it's commercial or residential. So
That's okay. So basically, what he's suggesting is with a 1031 exchange, you can defer those capital gains by putting it into another property. I know there's a certain period of time between sale and purchase. You have to have, is it like, how many months is it?
it's a kind of stuck on it. You have to identify within 45 days and close, I think, 180 days.
Okay.
I might be wrong on that. It's
And when you say identify, do you mean you must have a contract to sale?
to buy. You have to identify that. That's to me, identify means that you just I found that you're pointing at a property. That's the one I want to buy,
Oh.
and you've taken steps to put
okay,
an
so-
offer in and
okay.
so on.
All right, so that's pretty good.
Yeah.
That's pretty good. Yeah, so there's a lot of creative ways. Obviously, if you're into real estate investing and you need some advice, you can obviously call Rains and Company. They can help you out with that. This is completely off topic, but I know it's been all over social media and the news. The possibility of in the future income tax going away and there just being a huge increase on sales tax instead. What's your just general take? I know I'm throwing a curveball at you, but
Well,
I think the viewers would just kind of like to hear a CPA's opinion of what they think about that. Again, this is your opinion.
I know. I think
It sounds crazy to me. That's why I'm asking.
I know. It sounds really crazy too to me, but then sometimes it seems like it would make a lot of sense. But I think you have to look at what that means to someone. So if you have, I don't think it's a good idea because of if you have a low income person, their taxes are going to be on the lower side. And in fact, their taxes might be zero with credits coming back to them if they have dependents. So now you put this national sales tax on things besides the states, right? So, to go to the store and buy whatever it is, I mean, you're talking about adding on a whole layer of tax that, our tax system is wrapped around, sort of trying to be fair. I mean, people will argue that it's not, or there's issues with everything, right? But to me, a national sales tax, if it's going to be 15 or 20%, that means everything you're buying, everyone's paying that 15 to 20%. So someone making $1 million can go out and buy something and pay $20, but then someone that makes $10,000 is going to pay the same $20. So I'm not really sure like the rationale behind that. And because
Okay.
I think there's a lot more holes in that concept than there is in what we're dealing with right now.
Yeah.
And I think the part that everyone kind of gets caught up with is that when they do talk about tax changes, there's a long-term plan that they're trying to follow that's wrapped around debt, right? And we, as just taxpayers, get caught up in the emotion at the moment. Is like, it's, well, how is this going to affect me right now? We're talking, these changes affect 10 years, 20 years down the pike. We're our kids, our grandkids are affected by this stuff, right? So it's, in one respect, I wish people would kind of just absorb a little bit more before they react and talk. And on others, I wish the people making these laws actually ran businesses and were like in the shoes of people that they are today, so they can actually feel what people are feeling. And to be honest with you, I don't understand how you can get a job in Congress without actually knowing that type of stuff, and make the laws.
That's a whole nother podcast, right?
I know.
Yeah.
So.
No, it is true. You see, even with, in my business with compliance, banking regulations, and all these rules that they put in place, and it's like the people putting these rules in place have never sat down and done the loan officer job and disclosure job. Like, there's so many disclosures now that go out, and it's like they're forced, like you're forced to send out a disclosure when something changes, even though it's not really changed and it's going to change again 3 times. and borrower, you may have conversation with the client saying, hey, this is what we're doing, this is how, this is where we're going to get, and then they get a disclosure that says something completely different because it's not updated yet. It's created a lot of confusion with borrowers that the intent was to help them, but it's only confused them more. In more cases than not, it's only created more confusion. So that's just my only comment to what you're saying. Is it just makes perfect sense.
Yeah,
It's the same thing.
Yeah. I feel like the system that we've built, we have a lot of people that just think and write things down, and I that just causes a whole lot of problem. I mean, I'm sure.
In their defense, they just don't understand it the way we
Yeah.
do. But there should be something to change that.
Yeah.
They should have advisors that either do it currently or have done it for a really long time.
Yeah.
At least to help them understand it better.
Yeah. Yeah.
That's not for us to say.
I know.
We're just trying to help people understand certain things. I mean, Chris, is there anything else? Now, it doesn't need to be mortgage related, but is there anything else helpful you think to share with our with our viewers with regard to taxes and stuff, and maybe something upcoming that doesn't necessarily have to do with mortgages?
Well,
just try to help and educate.
When you asked me to do this, I kind of kept on getting drawn back to when my wife and I, we're looking for houses, and it's a huge step.
Mm-hmm.
And I think it's it takes a lot to really dig into the numbers, and I feel like everyone that is even considering buying a home, getting a mortgage, they really need to understand every aspect of it, as opposed to relying on what I tell them, what you tell them, what the attorney tells them, what the real estate person tells them. It gets too confusing, and everyone needs to understand the commitment that they're making and what they are going to be saving. As far as I think that's my 2 cents for today, as far as helping people watching this podcast. And
I mean, thank you, because first of all, every time I talk to first-time buyers or newer buyers, I try to educate them on all aspects, but at the same time, I'm not you. I'm not a CPA. I understand what you're talking about more than your average first-time buyer who's never done it, clearly, because I've been doing this for a while. But I also don't want to just tell them, hey, this is what it's going to look like, when I'm not going to do their taxes. And I don't want to overstep. I want to make people aware. That's why we're doing this, to make them aware. But now that you're on here as a professional, we're really kind of confirming some more specifics. But, so just as a suggestion from a tax standpoint, talk to your CPA. I mean, now that you've listened to this, if you're, one of our, soon to be first-time buyers, renters, trying to learn and educate yourself, understand where your tax bracket is. I mean, I try to keep things as simple as possible. I do the same thing with mortgages. Like, people get so wrapped up sometimes, and they read all this stuff and they talk to a million people. There's one thing to educate yourself, but there's another thing sometimes too much information is very bad. So what we try to do is start from what's really relevant, very simple each step, and then ask questions from there. We're here to help you. You need tax advice. Rains and Company CPAs, their staff is definitely here to help too. Chris, let's talk about anything that you want to bring up as far as Chris also owns a few other businesses which do go hand in hand with tax preparation and tax advice. Is there anything there that you want to share or just talk about while you're here?
Well, so what we've been actually working on for the last year is growth, our own growth as a firm. So I started the company 20 years ago with Rains and Company, a couple different names since, but and also Candlewood Payroll, right? So we had the tax and payroll businesses. We are merging with another local firm called White Rabbit Financial, and they're going to bring in a whole new financial accounting piece to our business. Working with companies, cash flow, a lot of different things. Jim Podrowski is the lead person there. we're excited about what's going to be happening in 2025 for us. So we feel like we're situating ourselves to just be a stronger firm and to make a difference for our clients.
That's awesome. Sometimes I know with our business, when things got really, really crazy busy, especially in 2020 and 2021, it got hard to service everybody,
Yeah.
and then, just when it's just nonstop, which is a great thing, you have to have the right support. So, congratulations on that.
Thank
It
you.
sounds exciting for you,
It definitely is. We have a great team, and I think you alluded to that. I mean,
Oh, yeah.
when you call our office, you're talking to someone that's either going to help you or going to get someone that is going to help, and that is our main goal is to, to be the go-to person or have the go-to referral.
Right. Absolutely.
Yeah.
And that's like the same with us. If we can't, we do handle 99% of residential and commercial stuff too. But, if I know that we're not going to be the best fit, which is not often, but there's unique situations, I have the right guy or gal or company that we will connect you with. So, I mean, it's all about doing what's best for the customers, because that's what comes back to you, and that's one of the things that's always, anyone that comes to me that says, hey, James, I need a CPA, I need some help with taxes, there's not even a thought in my head who I'm sending them to.
Yeah.
So
Same here.
Yeah, thank you.
Every time I hear a difficult mortgage situation, I'm like, give James a call.
How about some of the easy ones, Chris? Huh? No, that's awesome. Well, I don't want to keep going on with this unless you have anything else to share. I think this has been an amazing day. I've learned a lot today myself, and so thank you for that, which will help me educate you guys better. But anything else you want to share today?
I'm out of material.
Out of material. All right. Well, that's a good thing. All right. Well, everyone, thank you for watching. Chris, seriously, thank you so much for coming on.
Thanks, James.
We'll hopefully you'll honor me again and down the line when we have changes to talk about.
Okay.
Right?
Sounds good.